Hello everyone and welcome to today's video. So what we have brought for today's video is understanding about what are bonds. Okay, so we all know how topsy-turvy the stock markets are now, right? And a person can't invest in FDs to get a 5 or 6% rate of interest, which is lower than the inflation rate. So a safe investment as on date would be to invest in bonds with a fixed interest rate that is higher than FDs, higher than inflation, and along with the security to receive the same amount at the time of maturity. Okay, so let's understand this in big detail. So basically, a bond is nothing but a fixed income instrument. Okay, it is as good as a loan that the company or a government is seeking from the individual investors, and in return, they give them bonds which will mature on a specific date and at contains coupon rate as well. Coming to the features, so these are basically high risk debt instruments. Bonds serve the main purpose of raising capital and fulfilling the capital requirements both for the companies or the private organizations and for the government. The investors generally are individual investors, though even the companies or even the institutions such as LICs, UTI, all of these are also the investors in bonds. But yeah, individual investors are also part of this investment, right? These are for specified tenure, and these are issued at a face value or a fixed principal value. So issued at face value means that suppose a bond will be of say rupees 100. So per bond it is 100 rupees. Okay, so you can buy 9 bonds, you can buy 10 bonds, you can buy 100 bonds. Okay, so that is issued at face value. And when it comes to fixed principal value, then it will be say a lot size of 10 bonds of 1,000 each, totaling to 10,000. So in that case, you can't buy 9 bonds, right? Because they have a fixed lot size. So the principal amount is fixed, that is 10,000. You can buy in multiple of 10,000s. Coming to the issuer, so issuer basically is nothing but the organizations, including the companies, governments, municipalities, and the other entities. Now, since looking at the behavior of stock market, how it is going plus some 7.8% and then going negative in the same direction or with the same percentage, right? So it's really risky looking at the stock market scenario now. So coming to the safety of bonds, individual investors are basically acquiring bond and they have legal and financial claim to the organization because it is as good as a loan or a debt given to the company. So borrowers are therefore liable to pay the entire face value of the bonds to the individuals after the term expires. So interest I and I uski guarantee is not there, okay, in the worst scenario, but they have to return the principal any which ways, okay. In the worst come worst scenario, coming to the priority at the time of liquidation. So in case the company goes bankrupt, okay, and they file for bankruptcy. So bondholders receive the debt recovery payment before the stakeholder in case of company. Okay, so even the equity holders, even the preference shareholders, they'll receive the payment later. First and foremost, they'll have to pay off their debts, and bonds are as good as debts for the organization. Coming to the advantages, so basically, bonds are providing you stable returns with guarantee, with safety. They are indentures, that is, it provides you the safety because you are providing debt to the organization. Okay, so they are indebted to you, and in return they have to pay you at the time of liquidation as well in priority to the stakeholders of the company. And this also is helping you diversify your portfolio. So investing all your money in US stocks, Indian stocks, cryptos, that will not help, right? You have to keep a fixed income based investment as well in your portfolio, so that can be bonds instead of investing in FDs. Okay, coming to the limitation, so limitation again would be this will have lower returns compared to what you can see in stocks or cryptos or maybe US stocks, okay, over a period of time. This has limited liquidity. Why limited liquidity? Because these are not easily tradable like stocks. Okay, so they'll only be in majority cases they'll be repaid at the time of maturity only. There are chances whereby you can sell them and buy them in secondary market, but it's not that liquid. Inflation's influence. So basically, this will not increase or decrease with the inflation rate, right? So as of now, we can see that the inflation rate is increasing, but the instant rate or interest rate over here will remain constant. So this does not have any inflation's influence on the interest rate. So hope this video help you understand what bonds are, what are their advantages, what are their disadvantages, why one should invest in bonds, who are the issuers, and what all things one should know regarding bonds before investing in that. Okay. So hope you like the video. We'll be out with a new video soon. Till then, stay healthy and stay safe. Thanks.